Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, welcome to episode 74 of the On My Way to Wealth podcast. My name is Luis Rosa, and I'm your host. Thank you all for tuning in. I want to talk about real estate, specifically when it's a seller's market, when there are more houses that people want to buy than there are available. It's basically all supply and demand. That's really what I mean by a seller's market. You probably heard the term seller's market. You've heard the term buyer's market. What happens is if you're a seller right now, you have a lot of options because there's probably more buyers looking for home than there are homes available for sale. And that's what a seller's market is. The seller has the upper hand. The opposite happens when a buyer's market occurs where there's too much inventory and there's too many houses for sale, not enough people willing to buy them. All right, so then that's when sellers don't have the upper hand and buyers do. They can negotiate for a lower price, etc. As of the recording of this podcast, what's going on right now, in my opinion, is part of it is the result of the pandemic. Number one, we have over a year that people have been cooped up in their houses, have not been able to go out and spend money. So there are lots of people who were not negatively impacted financially from this pandemic who have accumulated more money than they normally do because their student loans were put on hold. They were not going out to eat. They were not going on trips. They were not spending money. So they accumulated money. They were able to keep their salaries working from home. Now that things are starting to reopen, there's a lot of appetite for things like real estate. So there's so many people looking to buy homes that certain markets have experienced just like a craze. I've heard clients telling me that there have been bidding wars, properties that they've been looking at. So a house is for sale for $300,000, and then somebody comes in and offers $310,000. Then somebody comes right after them, offers $320,000, and next you know the price just keeps going up and up. I've also seen where sellers are hesitant to lower their price, and actually they're firm and do not lower their prices because they know that somebody out there is just going to give them the higher price, even if the house isn't worth it. Like I've seen scenarios where the house appraises at a lower price, at a lower value than the seller is asking as the actual sales price. And some people still buy it, even so. And that's one of the things I'm going to talk to you guys about in this podcast here today. The other thing too is the properties are not staying on the market too long, depending on what area of the country. And I mean, some houses are just flying off the shelves where people schedule an appointment to go see it. And then they get a call back. Sorry, somebody already put an offer on it. I mean, that quick. That has caused people to even buy homes without even physically seeing them. I know of people who have put bids on houses, just photos that they saw on the listing over the internet, call the realtor, say, put it in an offer. I mean, it is insane, right? So if you happen to be in that situation or you are about to hop on on board with this market, I want you to be on the lookout for certain things so that you make an informed decision when it's time to pull that trigger. So let's run through some common examples I've seen with my clients encounter lately. I'm going to go with two major ones. One scenario is where you get your offer accepted, right? You saw a house, you loved it, you like it, let's go, let's do it. You put in your offer, it gets accepted. Then it turns out you start your mortgage process, everything goes according to plan. The house gets appraised by the bank, the appraisal comes back, and the value is lower than the agreed upon sales price on that contract that you signed and the offer that's accepted. So the house appraised for less than the listing price. Now, what do you do? What can you do? Well, there are two things you can do. One is you can negotiate with the seller and say, look, I'm approved already, as you know, with my mortgage company. I had the house appraised. It came in lower than the sales price. So are you willing to negotiate? Now, the seller doesn't have to necessarily, so they can say, nope, sorry, I'm not willing to negotiate. One option that they can do is tell you, I'm standing firm with my price, take it or leave it. So that, that's your choice. Number two, some sellers may work with you and meet you halfway. So what I mean by halfway, let's say the house appraised for 10,000, 20,000 lower than the sales price. They might say, look, I'll lower $10,000. I'll lower $5,000, something like that. But you still got to come out of pocket with the difference, right? The third option is you could just walk away. So just make sure though that you have that clause in your contract before you sign it that lets you walk away if the house does not appraise. I mean, that should be standard, but just make sure you confirm either with your attorneys or title company, real estate agents, whoever you're working with, to make sure that you have that clause, because you do want to have that option. You may not want to overpay for a house depending on your situation, right? So you want to make sure that you have that ability to either negotiate or walk away, right? Now, let's say that you did in fact agree to move on. I'm going to give you an example. Let's say we're buying a $400,000 price home, right? And let's just go with a 20% down payment just to keep the number simple, which is $80,000. So your loan amount is $320,000. Let's say you submit your application, you got your offer accepted, everything's good, the mortgage is being processed, appraisal goes out, comes back, and the appraisal is $380,000. That's a $20,000 difference. Now you go back to your seller and say, hey, listen, the appraisal just came back, it's $380,000. So can you lower the price to $380,000? They might say to you, no, not really. I still want $400,000, because the current situation is, the market is, it's very possible somebody might still come and say, you know what, we'll give you the $400,000 even though it's worth $380,000. That is happening right now. So you might have that situation where, like, all right, what do we do? Do we pull out now? The seller said no, they're not willing to negotiate, not even a bid. They're not willing to come down to $390,000, $385,000, nothing. So here's what happens, because I want to help you make this decision if this happens to you. Most people don't realize that when you get pre-approved for a mortgage, the bank is only going to lend you based on the lower of the sales price or the appraised value when you're going to buy a house. What I mean by that is, if you go to your bank first, which is a good idea before you start buying or even looking at homes, you do want to get pre-approved, whether it's a mortgage broker or a direct lender. You want to make sure they see your income, assets, your credit, et cetera, so that you get a pre-approval. Because once you're pre-approved, you know the range of home that you can go see. You don't want to fall in love with a $500,000 house if you could only get approved for $350,000, right? So make sure you get your pre-approval. So here's what happens though. A lot of people don't realize that the pre-approval number is always based on the appraised value. So let me give you this example. If you get pre-approved for a $500,000 loan amount, for example, and you find a house that's $400,000, the bank is not going to lend you $500,000, because they're not going to lend you more than the house is worth. Because in their case, if you stop making payments and they have to foreclose on that home, they don't want to end up with a home where the loan balance is higher than the appraised value. They want to be able to turn around and sell that home, get their money back that they lend you, and keep it moving, right? So if you're pre-approved for $500,000, you're not going to get $500,000 if the house that you choose to buy is lower than your pre-approval amount. It's going to be based on the sales price of that house. So if you find a house in this scenario for $400,000, even though your pre-approval is for $500,000, the bank is going to say, okay, great. We're going to lend you the loan amount based on the percentage of the down payment of the home that you're buying. So in this case, if you were buying a $400,000 house with a 20% down payment, they're going to lend you $320,000. Even though your approval is for $500,000, they're only going to lend you 80% in this case, because you're putting 20%, right? 80 and 20 is 100. So you put 20% down, they lend you 80%. So just keep that in mind. And the reason I bring this up in this particular scenario is because if you're buying a house for $400,000 that only appraised at $380,000, then the bank is going to also look at the appraised value, not the sales price. They're going to lend you on the lower of. So in this scenario, if you were putting 20% down on $400,000 is $80,000, you were going to borrow $320,000. But when the appraisal came back at $380,000, the bank has to adjust and say, okay, well, now your down payment is $76,000, 20% of the $380,000, not the $400,000, because they're going to lend you based on the appraised value. And your loan amount goes down as well from $320,000 to $304,000, 80% of that $380,000. All right, so now you're borrowing $16,000 less, and your down payment is $4,000 less. Those two combined are $20,000. However, you have to come out of pocket the $20,000 difference. If the seller held firm and say, I want $400,000 for this house, the appraisal is $380,000, your down payment and your loan amount are going to add up to $380,000. So the bank's going to lend you 80% of the appraised value. You're going to put 20% down of the appraised value as well. Those two combined are going to make up only the appraised value. So that $20,000 difference, you have to come out of pocket. It's not going to be able to be borrowed in your loan unless you restructure your mortgage to put less than the 20% down. Then you have to consider other things that may affect your interest rates. If you tell the bank, look, all right, I don't want to come out of pocket more. Let me just borrow 90% of the value, right? You could do that, very likely if you qualify for it. But now you have higher interest rate. And there's also something called PMI, which stands for Private Mortgage Insurance. And if you're doing a FHA loan, it's called MIP, Mortgage Insurance Premium. In essence, the bank has to have you pay for an additional monthly amount for this insurance because now you're putting less than 20% down. So your monthly payment will go up as a result because you're getting a higher interest rate and now you got to pay PMI if you're paying over the 20% down, right? Less than 20% down. So that's one thing to consider, right? So that off the bat is making your payment go up. Number two, what are you giving up? Because now, let's say you do have it, you have to give $20,000 more into this transaction than you were expecting to. Now, there's something called opportunity cost. This brings me back to my college economic major years. I'll try not to make it too boring, but I really love this stuff. The opportunity cost is, what could have I done with this $20,000 instead, right? Because you got to look at it not just from the standpoint of, okay, I'm only coming up with $20,000 and it ends there. It doesn't. Because had you not had to come up with the $20,000 extra, let's say you would have invested it. So I'm going to run through a quick scenario. Say you're buying a home, you're doing the traditional 30-year mortgage. You could have invested this $20,000 for those 30 years. So let's say that you did at 7% rate of return average over a 30-year period, $20,000 without adding anything else to it would have grown to slightly over $152,000 over that time period. Now, in order to compare apples to apples, we have to also see how much you save in mortgage payments. Because if you remember, when the house was $400,000, you were borrowing $320,000. When it appraised at $380,000, your loan amount went down, right? So to $304,000. So that difference in monthly mortgage payments is $67. So when I multiply that times the 30 years, comes to about $24,000. So on one hand, the $20,000 that you forego that you could have invested would grow to $150,000, could have grown to $152,000. The savings in mortgage payment is $24,000. So when you subtract the 24 from the 152, it's $127,000 that it cost you over a 30-year period for buying a home that was $20,000 over their asking price. Now, I'm not saying that that makes it where it isn't worth it, because there are also some intangibles that you should consider. Let's say this is your primary residence. You loved it. You love the area. You have young children. You love the school system. Perhaps before you were paying for private school, and now in this particular area, you won't have to because the school system is so great, right? These are the kinds of things that you would consider that have nothing to do with money. So what I'm trying to do here is so at least you make that conscious decision. Say, look, if we have to come up with $20,000 extra, this is what it's costing us in reality, $127,000. Do we want to do that? Are the other factors worth doing that? The school system, raising my family here, creating memories, right? It might be worth it. You might say, yeah, you know what? I still think it's worth it. Then absolutely go ahead and do that, right? Because there's so many intangibles, and some of these things may be priceless. So, but at least you know that you're making the decision based on all the possible factors, right? Now, if you were buying this as an investment property, then you want to look at the numbers a little closer, because if you didn't care about the school system and all that stuff, and it was straight up a business venture for you, just an investment, you want to look at this scenario a little closer, because now you say, hey, this is really costing me $127,000 more because I'm overpaying by 20 right now, but that money compounded over time is going to cost me. So that's going to eat up at your bottom line. Now, it might still make sense because of how high the rents are in the area or the property appreciation over time, but you got to look at the numbers a little closer because there's not as many intangibles, right? You're not looking at your school systems and creating memories with family, nothing. It's just a straight business venture. So I want you to consider that. Now, this is why it's so important to work with a financial planner, some professionals in your corner that can serve as thinking partners and help you evaluate these decisions. A lot of times people think that you need to have a whole bunch of money to work with a financial planner. Not necessarily the case. These are the kinds of decisions that advisors can help you with that have nothing to do with investing, just real life decisions. Hey, here's the situation. I'm trying to buy this home. It didn't appraise for the contract sales price. Is it worth me going forward? Or what are the consequences? At least you make an informed decision, right? Let's run through another common scenario. And this is where a bidding war breaks out, so where people have multiple offers on a house. So let's say the same house, $400,000. But in this case, let's say that the end result of the higher bid price, that the house does in fact appraise that much higher. So I'm going to run through that scenario with you as well. So let's say you found a home, $400,000, you put in a bid. Real estate agent says, okay, I'm going to go put it in. I'll get back to you. Then they call you back. Hey, listen, somebody else offered higher than you. Could have been 405. Then somebody else did 410, 415. It ends up 420. Realtor calls to say, hey, listen, the sellers really liked you. They would rather give you the house. However, it's listed at 400, but there's been so many offers on it that they want 420. All right. So what do you do now? Same scenario. You can say, you know what? No, forget about it, or try to negotiate. But let's say they stand firm. There's no negotiation. It's 420. Now let's go back to the numbers again. Let's say you decide to go forward with this. Now you're paying again $20,000 more than the house it was listed for. But in this scenario, when you send the appraisal out, it actually comes back at 420. So what do we do? Well, a slightly different scenario, because now the out-of-pocket expense is $4,000. The reason for that is because at $400,000, your down payment would have been 20%, which was $80,000. Now, when the house is $420,000, it's $84,000. So you have a $4,000 difference there that you have to come out of pocket. So that's more of a down payment. It's not as large as the other scenario, right? $4,000 more, but remember that the lender is going to lend you based on the appraised value. So now they're going to lend you 80% of the 420, right? Which is $336,000. That's $16,000 more. So the extra $4,000 down payment plus $16,000 more out of pocket for that loan amount, rather, makes up that $20,000. So here's what you're giving up in this case: the opportunity cost, $4,000 invested over a 30-year period at 7% average is going to be slightly over $30,000. Now, since you're borrowing more, we also need to take into account the $16,000 difference in your loan amount, which it's $67 more. It'll cost you over $24,000 over the life of the loan. And this is just assuming you're keeping the house for 30 years, because I want to make the numbers simple. Obviously, there's so many factors. You can move in 5 years, so scenario will change based on that. So under the first scenario, you were saving the mortgage payment. So I had to take that into account. Under this scenario, you're paying more, right? So $24,000 plus the $30,000 is equal to $54,000. So when you add up the additional mortgage payments plus what you gave up with the $4,000 extra in closing costs, it's $54,000. Now, that's not huge over 30 years period compared to the $127,000 that I talked about in the first scenario, right? So huge difference. So I guess if you're going to be in this scenario, it's much better if the house actually appraises at the higher amount of the bid. Because under the first scenario, you do have to come out of pocket with that difference, right? Which is pretty big, and it may make or break the deal for you. So keep in mind these two scenarios, because they are very possible under this current market. They might happen to you. And at least now you have some idea as to how to handle these, right? You know your options. You know that you can negotiate. I mean, everything's negotiable, right? You can try and negotiate, say, hey, listen, appraise lower. Can you meet me halfway at least, right? Something like that, right? So you can at least do something that benefits you and it's not as bad as just overpaying for it entirely, right? So that's one option. If they don't budge, you might walk away. Or if it's worth it to you because of other intangible factors, then you go ahead and do it. But at least you know what you're getting into, what you're giving up, the true cost of it. So you can make that decision. So I hope you find this useful. As always, thank you for tuning in. If you have any questions, any suggestions, anything, send me an email, luis@onmywaytowealth.com. I look forward to seeing you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.